Hey everyone, Anand here. Welcome back. I hope you liked my last video where I covered how to analyze a stock using simple key insights. If you haven't watched that video, you can watch it here. In today's video, we'll dive into a fundamental concept of value investing, compound annual growth rate or CAGR. We will explore what compounded annual growth rate or CAGR is, how is it calculated, how is it different from total return, its uses, its limitations, and finally, how do we use CAGR at Let's Value Invest or LVI. So let's get started. Let us say you invested $1,000 into a stock 5 years ago. I ask you, how has your investment done? And then you start telling me a story of numbers. You say that it grew by 20% in the first year, then 33.33% in the second year. However, in the third year, it went down by 18.75%, but again it went up in the fourth year by 7.69%, followed by another 28.57% in the fifth year. And this is how the investment has worked so far. Now, if I have to visualize this and compare this to, let us say, another investment, how do I do that? So I tell you, hey, don't tell me this boring story of numbers. In order to understand and also compare, I need a single growth rate that can represent the above graph. That representational growth rate is called CAGR or compounded annual growth rate. In other words, I would like to know on an average at what rate your investment of $1,000 has compounded over the last 5 years and has now become $1,800. Don't give me these individual growth rates as it's hard to comprehend and compare this way. So now I think we can define what CAGR is. CAGR or compound annual growth rate is a powerful metric used to measure the average annual growth rate of an investment over a specific period, assuming that the investment grows at a steady rate each year. Let us see how to calculate this CAGR for you. If you have to grow your money at a given rate for a given number of years, the formula to calculate the final value or FV is PV, that is present value, into 1 plus R, that is rate, to the power of T, that is time. This is the compound interest formula that we all learned in school. In our case, the formula becomes this. So the question is, what is rate or R? The above equation can be solved for R as this. If we substitute our values, then R becomes this. Solving for R, we will get 12.47%. Obviously, we can't do this calculation in our head, but there are simpler tools to do this rather quickly. And one way to do this is to use an Excel sheet or a Google sheet to do this calculation using the formula that we just discussed. Another way is that you simply go to Let's Value Invest or LVI and open the CAGR calculator, which is free to use, input the present value, the future value, and the number of years, and it is promptly calculated for you. Simple enough. So basically, I can conclude that your investment of $1,000 compounded at an average rate of 12.47%, and it should look like this. This 12.47% is a representative figure for the year-over-year growth you mentioned to me earlier. Or in other words, we can also imagine that the investment of $1,000 grew by 12.47% year over year for the next 5 years and became $1,800. The CAGR between the initial and the final year basically smooths out the ride, hiding the volatility in between and shows a consistent ride. Total return calculates the overall increase in investment value over a period expressed as a percentage. The formula for total return is final value minus initial value divided by initial value times 100. In our example, as it turns out, the total return is 80%. Total return focuses solely on the percentage increase in value without considering the time taken by the investment to grow. As you can see, the above formula doesn't have any place for time. and that is where it differs from the CAGR. When someone says that an investment has doubled in value, all we know is his investment value has doubled, but we don't know how long did it take to double. For example, if it took 10 years, then the return has been 7.18% compounded annually, just about the average return a broad-based index like S&P 500 provides over the long term. However, if it took 5 years, then it has been an impressive 14.87% CAGR, probably beating indices over that time. And if it has taken only 2 years, then it has been an amazing 41.42%, and it is, well, a Peter Lynch moment for him. In our case, we can safely say that your investment has grown in value by 80%, compounding at a rate of 12.47% over the last 5 years. In summary, total return and CAGR are essential metrics in investment analysis, each serving a distinct purpose. Total return quantifies the overall percentage increase in investment value without giving consideration for time. Compounded annual growth rate, or CAGR, measures the average annual growth rate, incorporating time to provide a standard annualized growth rate. For value investors, understanding CAGR is crucial because it helps evaluate the historical performance of investments in a meaningful way. For example, by calculating CAGR, we can find how consistently a company has been able to grow its revenue, free cash flow, and profits, and so on. CAGR also allows us to compare returns from different types of investment and helps us make an informed decision. For example, imagine you have two investments, a CD offering a steady 4 to 5% CAGR and the VOO ETF from Vanguard with a historical CAGR of 10%. While the CD appears safer with guaranteed returns in the short term, we can easily see the potential for significantly greater returns with VOO, especially when our investment horizon is longer. In short, if you prioritize guaranteed returns and low risk, the CD might be suitable for you. But if you have a longer investment time horizon and can stomach some market volatility, the VOO's potential for higher growth might be more attractive for you. Similarly, we can compare past returns of different ETFs and then choose the one we think will be best suited for our portfolio and the time for which we want to invest. We can also compare the returns from the different asset classes in the past and see where we should invest and how we should construct our portfolio over the long term. We have often heard people mentioning that someone bought this house 50 years ago for, let us say, $100,000, and now the investment has become 15 times to $1.5 million. It indeed appears the investment has grown by much if we just look at the total return. But if we also take into account the time and if we calculate the CAGR of this return, this turns out to be just above 5.5%. It may be good, but definitely not great. Similarly, we also keep hearing how a burger that used to cost us $1 in the 1970s is now costing us $6 after 50 years. We can quickly calculate the CAGR at which the burger price increased from $1 to $6 over the last 50 years and find out the price increased at a compounded annual growth rate of 3.65%. And if burger's price were to increase at a similar rate in the future, then 50 years from now, the same burger would cost us $36. And hence, in order to be able to afford the same burger 50 years from now, we should look to grow our money at a much better rate than, say, 3.65%. Here I think since CAGR factors time into the calculation, it keeps things into perspective and helps us make proper comparison. As we already saw, CAGR is a powerful tool, but it's not perfect. It smooths out the bumps in the road, so it might not capture the full volatility of an investment and just shows us the rosy picture. When we see the last 10 years price graph of Google, it's easy to get excited to see that it has given investors a compounded annual return of 20%. But if we look at closely, it's clear that the journey has been far from smooth, and there have been many bumps on the way, and one needed a solid conviction based on proper understanding of the Google's business to ignore the volatility and to remain invested in order to reap the full benefit over time. Also, always remember that the past CAGR analysis doesn't guarantee in any way a similar return in the future from the same asset class. Google stock has returned over 20% compounding returns in the last 20 years, but has only returned about 9.5% in the last 2 years. And there is no guarantee that it will return more in the future. Here at Let's Value Invest or LVI, we take CAGR to the next level. We calculate CAGR for different metrics like revenue over various time frames, 10 years, 5 years, 3 years, and even in the last 12 months. Why? It's like taking a company's growth story and breaking it down into chapters. The question you may be asking is, why look at different time horizons? Well, by seeing how a company's revenue has grown over 10 years, 5 years, and even the most recent year, we get a clearer picture. In my opinion, this way we can spot trends and potential slowdowns. In the case of Alphabet, we can already see that the revenue was growing at above 18% per annum in the last 10 years, but that has come down to 9% in the last 3 years. So we can conclude that the revenue growth has slowed down in recent times. However, we are also seeing that in the last 12 months, that growth has gone up again to almost 12%. Does that mean the Alphabet is going to grow its revenue double digits again in the future? Will it go back to 18% or will it remain in the low double digits? Or will it come down to higher single digit growth rates? As you can see, there are various possibilities. Of course, we'll be able to make an educated guess only after we have taken a deeper dive by reading into Alphabet's last few years of annual reports and at least the earnings release of the last few quarters and taking note of what management has said. But that discussion is for another video. At least for now, we can agree that predicting the future is impossible. But as value investors, we rely on past data to make educated guesses. A company with a history of consistent growth, like a steady increase in revenue year after year, suggests they have a good chance of keeping it up. And in this aspect, knowledge of CAGR helps us analyze this past performance. That wraps up this video. I hope you found it informative. Feel free to leave any questions you have in the comments section below. And if you would like to be part of my journey to learn, invest and learn, then be sure to subscribe to my channel. See you in the next video.